how long is this market downturn going to last? In this episode, we'll be talking about how long downturns last and how to make the best of it. Hi, I'm Bridget Sullivan Mermel, and I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shearer. I have a fee-only financial planning practice in Middleton, Wisconsin. And before we get going with this episode, Bridget, I want to remind viewers to hit that subscribe button. That helps other people find our content online and learn these things that you're going to learn today. And I'm excited. Talking about learning things is, when is this downturn going to last? I'm getting ready to take notes when Bridget tells me that I'm going to be able to make some moves on it, right?
Well, first I want to just talk about why we don't remember. So I was just reading this book, is Don't Trust Your Gut by Seth Stephens-Davidovitz, and he was detailing in granular descriptions, including medical procedures, about why we're not good at remembering pain. So we remember we had pain, but we don't remember how intense it was or how long it lasted. And I think that's true with market downturns too. People just remember, I felt bad. They don't remember how long it lasted or how intense it was. Yeah. And I think that's absolutely true with the stock market.
That's such a great analogy that I think of my sons when they had to get their vaccinations and things. And I've got one boy, and it takes a half hour to give him a shot, right? and of course it stings, right? You get a shot, but and then it's over in 10 seconds or whatever the deal is. But every time it's so hard, you have that, it hurt and this is bad, and then you have these feelings of anxiety that build up. And I think it does relate to, hey, we've got high inflation, the markets aren't doing well, maybe there's recession, and you forget what goes on and how it works, and maybe my memory of it is worse than what the actuality was in some cases.
Well, and I think people think of the worst case, go to the worst case scenario. So this episode also was inspired by a email I'm on with the Money Guys called FYI by FTE, the acronym lovers. Anyway, and they pointed us to a chart that shows, each different length of a downturn, how long does it usually take to recover? And this chart is put together by Guggenheim, and we'll put a link to it in our show notes. Okay, so it's very interesting because it just gives us the detail. Okay, so let me just read the chart for you. We have been down over 20%, so it's about 25% down. Mm-hmm. The market's down about 25%. And the top of the market was at the beginning of the year.
Right. So about 6 months or
so
when
it's
we're
been
recording
about 6 months. Yep. Yeah. And so that means we're about 6 months into it. And according to this chart, if the downturn is over 20%, then it usually takes about a year.
The total downturn.
Right. Yeah, exactly. And we've already 6 months before we're even filming this about how long is it going to last. So that means we're about, halfway through.
And see, and I take a little bit exception that maybe we're halfway through, right? If it's 10 years, if it's 10, a year on average, sometimes it takes 2 years. Sometimes it takes 2 months, right? We had a big downturn, and it was 45 days back in 2020, right? So as I look at that, it's, I don't know, maybe we're about halfway through, which also means, maybe we got some more to go, right? So what's the takeaway for me is, well, don't be surprised and shocked when if the market goes down another 5, 10, whatever percent in the coming months. You go that's one of the possibilities. Right. Maybe we're about halfway through. Maybe we're starting to turn the corner. Maybe we're not. But you go listen, it doesn't last 10 years.
Right.
It's typically about 10 months.
Right.
That sort of a thing.
Yeah.
Right. So you go, a year and a half, right? Likely we're not going to be having the same conversation 5 years from now.
Right.
Right. Maybe 5 months from now we will. I don't know. We'll see.
Right.
Yeah.
And the other thing is that I think that we have to see what news we get. Okay, because the stock market is very sensitive to news. And so if we have some good news, it'll recover quicker. Mm-hmm. If we have bad news, it'll recover slower.
Take notes on that. If good things happen, right? And again, logical, but and what's really interesting, I think, about that is it's news, right? By definition, we don't know what tomorrow's news is. So what we want, my feeling, I wish I knew when to call it. I was teasing you earlier, but hey, if we could call the bottom, right, then we know how to do this. Well, by definition, we need to know what's going to happen tomorrow. Right. And of course, none of us know what's going to happen. And when you think about that, just put that together, right? Markets get driven in large part by news.
Right.
And news is by definition unknowable.
Right.
And yet I want to know what the market's going to do, but unless I know the future, I can't do that. So that's where I think these things are so valuable, is to have some perspective, right? And it goes back to that, getting a shot or remembering pain is, I can remember the pain and I do not want to go through. How much more pain do I have to go through? But then if I can step back and go, wait a minute, here are some of the facts. Oh, that's right. Getting a shot, it only lasts for a minute. And that's a bummer, but I can live through a minute, as opposed to overreacting like you do when you're a little kid and you go, oh my gosh, this is going to be, cutting my arm off sort of a feeling. Wait a minute. No, this is part of the process, right? And having some of that separation, those feelings are legitimate. But then, all right, what have the facts been? And for me anyway, it helps me to go, oh, that's right. Maybe we got a year of this. Maybe we're halfway through. But this is what's happened. I think that's really a useful tool to help maintain your sanity and maintain your discipline in these times.
Well, and I think that we also have to note that this is short-term thinking that we are doing right now.
Yeah,
so
right.
We're thinking, how long is the short-term pain?
Right.
Versus,
right.
And long-term, we know that the markets trend up.
Mm-hmm.
So it's like, when are we going to get back on that swing? When are we going to get back on the upswing? We're not quite sure. So the other thing is that if there's bad news, that will extend, and the markets go down, that will extend out how long this goes. But remember, we've already started. So let's say we get some bad news at some month, October, November, December, whatever. At some month we get bad news. Okay, but then we've already been out 10 months, or 10, 11, or 12, some months. And so then we're adding on. So when you're looking at the chart, even if it ends up going down over 40%, the average length is 22 months.
Yeah, basically 2 years, right?
Yeah, and then sometimes it goes out further, like a lot further, but there's less times that's happened, so the data is a little sketchier, right? And so, so even if, like, say we have something bad happen at the end of the year and the market doesn't recover, okay, but then it's already been out. We've already been out almost a year, and so then the next year we can look for another lengthening, But
again, it's this short-term thinking.
Yeah.
I really love that. This is the long-term. This conversation reminds me, and I was in business back in 2007, 8, 9,
Right.
and the market went down, and it was 18 months or better before it hit bottom. That's not even get to recovery sort of a thing. And then it took, 4 or 5 years to recover, right? But you think, oh, that's a bummer, and absolutely, right? But think about this: the worst economic event since the Great Depression in the 1920s and 30s, right? And in 70 or 80 years, the worst thing that's happened, and in 5 years, you're kind of back to normal. And that doesn't mean it's going to happen again, right? Who knows what happens? But you think about, we've got clients all the time say, oh, I can't, I'm going to be retiring. I can't go through 07, 08, 09 again. And again, it's sort of like, oh, that feeling of, I do not want to see my money go down 40% or whatever, right? But then you look at it, and I'll say this to people that I know well enough. I'll say, oh, so you wouldn't want your money to, and you look at what some of the numbers did, and you go, oh, so if you were to retire in 2000 today, and this is 07, 08, 09, so in 10 years, you wouldn't want to have twice as much money as you do today. Right?
If you had to put up with the 3 or 4 years of having a little less.
Right. And so you look at those things, and that brings up one other point I want to bring up in a second here, but when you look at that, you go, oh, yeah, that's right. Right. And again, it doesn't mean it's going to repeat, but you look at some of this history and you go, oh, maybe I shouldn't be quite as scared about getting that jab in the arm of having a 2-year downturn in the market. I mean, it's a bummer, don't get me wrong, but is it, it's not cutting off your arm sort of a thinking by looking at some of that history and seeing some of the facts. And the other thing about this too is that, Bridget and I are both big proponents of having a bond ladder as you get into retirement. If you're working and the market's down, you're buying things cheaper. Hey, that's fine. It's when you get to retirement and you go, golly, where's my money? And all of your money shouldn't be in the stock market anyway, right? Some of it should be in your pantry, in bonds, in cash, and those things. So when we look at these market downturns, it's not all of my money has gone down. It's, and bonds haven't been doing awesome, but that's, that's safer, that's less volatile than those other things. So as we think about this, I talk all the time about people, the market's down this. Remember, we've got this pantry, we've got this bond ladder, we've got this security base that can last for 3 or 5, 7, 10, 15 years. And that also gives you like, that's right, I don't have to worry about my cash flow. I can have a longer term time horizon. What happens in the next 3 years is immaterial if if you've done those things. The fundamentals, right?
Right. And when we're looking at clients' finances, we're looking at their net worth. So I've been going through meetings recently, and we're going through everybody's net worth again, and we include both your portfolio and your housing, because that's an important part of your net worth too. And so for most people, their houses are up, and so their whole net worth is kind of staying about the same, or maybe going down 10%, but it's not really as bad as they think when they're watching the news. And we're hearing horrible news. Okay, the other thing I want to say is a ray of sunshine in horrible consumer sentiment numbers. Okay, so the University of Michigan has been surveying consumers since the 40s, and they just surveyed consumers, and somehow it's the lowest consumer sentiment that they ever have recorded. It sounds kind of crazy. But
I know you're going to give me a hard time about this because that makes me happy.
John is happy. Everybody's feeling bad, and John's happy.
Not because I'm sadistic, right? So really, when you take a look at some of those numbers over time, when consumer sentiment is really high, oftentimes following that, it's this reaction thing, right? When things are going well, I feel good after the fact they've already gone well, and then they start going badly, and then I feel bad after it's gone bad, and sort of acting in opposition to the herd mentality is when consumer sentiment is really high. I tend to be kind of cautious, thinking, okay, this is a time we should do our lifeboat drills and to think about what happens when it goes down. When I hear consumer sentiments at the all-time low, that herd usually follows, and it's not a leading indicator, but it's a trailing, it's like, okay, that means the opposite for me. Again, not a prediction, right? But I think, if sentiment is down, that generally has meant good things coming in the coming years. So I look at that in this weird way, and you go, sentiment's down, and I go, okay, you know what? The herd mentality more oftentimes leads people wrong than right. So I think that's sort of a positive as we look at the long term and the planning side of things.
So a lot of people are expecting the worst.
Right.
Basically, and the worst usually isn't as bad as the worst.
Right, that's right.
The worst is, what's coming up might be better.
That's right.
So anyway, I think that's a great time to wrap it up. I'm Bridget Sullivan-Mermel, and this is John Scheer. We both have family financial planning practices, and we see clients all over the country. I'm in Chicago, John's in Middleton, Wisconsin, and we're members of ACP, or the Alliance of Comprehensive Planners. So if you are interested in finding financial planning, you can let John or me know, or you can look for a local advisor on acplanners.org.
That's right. And don't forget to hit that subscribe button. Until next time.